Hello and welcome to the webinar Transfer Pricing Regulations in Vietnam. Before we start, can I just do a quick sound check? Can everyone hear me okay? Okay, if everyone can hear me, then I'm just go ahead and proceed. My name is Van Lee and I am the moderator for today's the fourth of the Investing in Vietnam series, brought to you by KPMG Vietnam. KPMG has been in Vietnam since 1994 and is one of the largest professional services firms in the country, with offices in Ho Chi Minh City, Hanoi, and Da Nang. Today, we are proud to have with us our two speakers for today, Mr. Dung Hoang and Mr. Nguyen Huyen, who are KPMG's experts on integrated tax, customs, and transfer pricing in Vietnam. Welcome, Dung from Hanoi. This is the first time we're having someone call in from two different offices.
My pleasure.
And welcome to Nguyen sitting with me in Ho Chi Minh City office. Before we begin, let me just run through the agenda really quickly. As you can see, we have an informative webinar planned for you full of key topics, which include an overview with some updates on transfer pricing regulations in Vietnam. And then also in the second part, key considerations for foreign investors and companies doing business in Vietnam. Next, we have set aside this time about 30 minutes for a Q&A session. If you have a question for one of our speakers, please submit your questions by typing into the chat window at the bottom left corner of the screen and then hit send. Collect those questions and then submit them to the speakers in the last 30 minutes as time permits. Without further delay, here are our two key presenters. Mr. Dung Hoang is the head of our Integrated International Tax, and he's calling in from Hanoi. And then we have Mr. Nguyen, who is our partner in transfer pricing services, joining me in Ho Chi Minh City today. Without further delay, because we have a lot to talk about, I'm going to turn the floor over to Dung in Hanoi. Thanks, guys.
Thanks, Van. Morning, everyone. I'm Dung. I'm in charge of Integrated International Tax of KPMG Vietnam. What I'm talking today is the decree and decree on transfer pricing based on the OECD recommendation regarding base erosion and profit shifting program introduced in late 2015. So what I'm talking about today is really the discussion that we got with the drafter, with the fiscal policy makers in Hanoi during the whole drafting process. So we are basically sharing all of the insight that we got that will be relevant to your business. So basically, Vietnam is among several dozen companies having written the international tax and transfer pricing regulation based on the OECD recommendation regarding base erosion and profit shifting. So the reforms are generally aimed at increasing transparency in tax matter between multinationals and tax authority worldwide, everywhere the group operates. Decree 20 is about managing the transfer pricing matters, and it's applied from fiscal year ending after the 1st of May 2017. So let's say it is fiscal year FY17. So for the first time, and this is a key point from the key requirement from the decree, taxpayer have to maintain a country-by-country report, a master file, and a local file. I will speak further about this documentation, and these are very important documentation as part of tax compliance going forward. The decree introduced quite a number of important trends around arm's length standard, common supervised benchmarking, and a couple of new deduction rules regarding service charge and interest costs. So obviously, the introduction of this decree would pose a challenge for multinationals, including those operating in Vietnam, to deal with the increasing scrutiny from the tax authority and making sure that they have the right level of transparency with the tax authority as required under the regulation. So let me step back to give you an overview of what OECD BEPS is about and the context of Vietnam Decree 20. So in late 2015, the OECD issued a package of 15 actions to address base erosion and profit shifting. These are mostly around international tax, and transfer pricing. And these are aimed at making sure that there will be coherence in the international tax regulation, transparency between taxpayer and tax administration, and substance. Now they are very focused on substance in looking at transfer pricing matter, and as reflected in the government decree. So if we look at the pictures, you can see that the actions color purple are basically those aimed at enhancing the substance. Action 8, 9, 10, 13 are included in the government decree 20 on transfer pricing. The other actions are about addressing the challenge of taxing the digital economy, CFC, limiting the tax-based erosion by interest deductions, preventing trade abuse, and some other important matters like permanent establishment. So action 13 is the key underlying actions of Decree 20. And here you can see that there is a three-tier approach for documentation that would need to be maintained by Vietnamese taxpayers. I mean, multinational operating in Vietnam and Vietnamese corporations in Vietnam and operating outbound as well. So action 13 is aimed at helping tax authority to perform transfer pricing and tax risk assessments, making sure that taxpayers apply the arm's length principle and provide information for tax authority to audit and achieve those objectives. For the first time, taxpayers are required to maintain the country-by-country report, master file, and local file. And all of these reports need to be available in Vietnam under the government decree. So page 10 gives us an overview of what's happening around the world around the country implementation of Action 13. Basically, 50 countries have been rewriting the transfer pricing regulation, and Vietnam is one of those who have came out with the final legislation effective from the 1st of May 2017. Most, if not all, of Vietnam major trading partners, including the US, many of the EU countries, Japan, South Korea, China, have adopted Action 13 in their local transfer pricing legislation. So let's go back to what we have in the government decree 20, and I'll be highlighting. This is a very complex decree, by the way. So I'll be highlighting the relevant change and the new provisions in the decree that would impact your business, your transactions, and what you need to do in terms of your fiscal year 2017. So Decree 20 captures 5 actions of the OECD BEPS package. Action 13, as I mentioned before. Action 8, 9, 10 on aligning transfer pricing outcome to value creation and risk assumptions. And Action 4, limiting the base erosion by interest deductions. And all of these actions basically provide the underlying principle of transfer pricing going forward. There is a general structures of the decree, which is pretty self-explanatory of what we have now. And we brought the official introduction of Circular 41, providing the guidance for implementation of some of these provisions, which are mostly around the benchmarking, the annual disclosures, and some of the important technical matters. So what's new under Decree 20? As I said, the Decree 20 provides 4 different forms. The master file in Form 3, the local file in Form 2, and a country report in Form 4. And basically, the required information in all of these forms are almost the same as what is being required under OECD Action 13 guidance. So for the company in Vietnam, where the ultimate parent of the multinational group is required to file the C/C report, a copy of that report will have to be maintained in Vietnam and provided to the tax authority upon the request. For Vietnamese taxpayers, Vietnamese corporation having annual consolidated group revenue of more than 18 trillion dong, which is equivalent to, they are required to file the C/C with the Vietnamese tax authority. The subsequent slide provide the details of the master file, the local file, and C/C. So let me walk briefly over what is being required in the master file, local file, and C/C. Without going to the details, because we can see from the slide and also a copy of the decree that we can provide later. The amount of information required is very extensive and intensive. So in terms of master file, the company in Vietnam would have to provide the group master file, which is normally created by the parent of the group, providing all sort of information around the group operations, the legal and ownership structures.
Can you speak up just a...
Hello?
Hello? If you can speak up a little, that would be great.
Okay.
Can you hear us?
All right. Is it better?
Okay, thank you.
Okay. Yep. So in terms in the master file, the parent need to provide information around their global supply chain, important information on their profit drivers, the different geographic markets they're operating in, and all sort of important transactions around intangibles and intra-group financing. And by the way, the new transfer pricing regulation are also giving separate clause on tax deduction around financial costs, intra-group service, and intangibles. So normally this file will be prepared by the parent, but it needs to be maintained by the subsidiary company in Vietnam and provided to tax authority as part of the documentation package. The local file is mostly on the taxpayer in Vietnam, providing information around the functions performed, asset utilized, and risk assumed by the company vis-a-vis its related parties, payments from the company in Vietnam, selection and application of the most transfer pricing method, what we call benchmarking, and a number of important information. Country by country report. This is a very important document. So for those countries which sign agreement to exchange the document, this report will be exchanged between tax authority automatically. Vietnam has not signed up for such agreement. So the government decree requires taxpayers to maintain a copy of this report, so we filed by the ultimate parent in their home jurisdictions and provided to a tax authority upon the request. So the idea of this report is to help tax authority to make an assessment of transfer pricing risks for their own purpose. And as you can see from the document, it requires around 20 different items across the revenue, profit, tax, capital, employees, asset, and different business functions performed in each of the countries where the multinational group operates. So Vietnam would go into one line here where the group has operation in Vietnam. So where they have 2 or more affiliate company in Vietnam, all of those companies would be reported in one line. And this is based on the local GAAP financial report. It is not based on the International Accounting Standard financial data. And one of the reasons why they got this CBIC, and this is a key change in Action 13, is it provides a transparency, transfer pricing, and transaction of the national group between the multinational group and tax authorities. It gives the tax authority an idea of where the group is paying tax, or where they are not paying tax, or where profit is created but it's not taxed elsewhere due to the tax system. And that gives the Vietnamese tax authority an idea of whether the amount of tax being paid in Vietnam is a fair share of tax. Of course, that is not the whole tool based on which they will make a transfer pricing assessment, but that is a tool to help tax authority to make an assessment of transfer pricing risks before, for example, they carry out a transfer pricing audit. So likewise, for Vietnamese corporations, the ultimate parent of those companies will have to submit this report to the Vietnamese tax authority. So all of the documentation need to be available before the Vietnam company annual CIT finalization deadline. So for example, for those balancing on 31 December 2017, the deadline for CIT finalization is 31 March 2018. That is by when they would have to provide, will have to have the master file and the local file. The CBIC will be subject to the filing in the ultimate parent home jurisdictions. The documentation doesn't have to be provided to tax authority upon the CIT finalization filing, but it needs to be available within no longer than 30 work days from the written request during the tax authority consultation procedures. Or in the event of tax audit, it needs to be submitted within 15 working days from the request. So that is a bit different from the current regulation where documentation is required to be available temporarily. It is now specifically clear that it needs to be available before the CIT finalization. So that means for those of you who are planning the transfer pricing compliance for this fiscal year, you should provide at least 6 months for this process for the very first years. For those who are ending on, for example, 30 June 2017 or 30th September 2017, it is a bit more challenge because basically the documentation need to be available this year. So we are happy to discuss further with you if that is going to be your case and how.
Hi Zoom, we've lost you for the last 5 or 6 seconds. Can
with
you
your group transfer pricing and see a copy of. Basically, for those who are having fiscal year ending 30 June, 30th September this year, 2017, having the documentation can be a bit of a challenge because it needs to be available within 90 days after your fiscal year balance date. So we're happy to discuss on how we are going to ensure that it's available before the deadline, working with your group, transfer pricing people. There are also new provisions in the decree that provide the safe harbor for small taxpayers or high profit taxpayers. But so basically those who are seen as having low transfer pricing risks and the documentation is exempt. So basically for those having annual revenue not exceeding 50 billion dong and the total value of transaction not exceeding 30 billion dong, they're exempted from documentation. Or for those highly profitable company having annual revenue of less than 200 billion dong, which is around 9 million US dollar, they exceed a certain level of profit, like 5% for distributions, 10% for manufacturing, and 50% for toll manufacturing. They're also exempted from the documentation requirement as well. Of course, for those who have an advanced pricing agreement with the tax authority in Vietnam, they are exempted from the documentation. By the way, there are now around 10 APA applications under negotiation or discussion with the fiscal authority in Vietnam. One has been concluded, advised by us, KPMG, And there are certain benefits in having an APA with a fiscal authority that we can discuss separately later on. Besides the master file, the local file, and country-by-country report, there is still a mandatory disclosure requirement in Form 01. So this is similar to Form 03 that you have applied for the past 3 years up to 2016. Form 01 improved from Form 03 in terms of the disclosure that are required of taxpayers, the clarity over what disclosure they need to provide to avoid any misunderstanding between the tax authority and taxpayer during audit. And so basically, it is now much clearer, and our team during the drafting process spent a lot of time with the policymakers, with the tax authority, addressing the practical issue that arise during the audit and the review process, and trying to get the maximum improvement that we could. And I'm happy that the current form is quite good. It's clear in terms of the disclosure that is being required. One example is it is now clarified on what type of transfer pricing methodology that you need to disclose. In the past, it was commonly understood, and it was a wrong understanding that it is the methodology that you apply in the documentation analysis that will be disclosed. And most time it is the transactional net margin method or comparable profit methods. It is now being clarified in Form 01 that it is the transfer pricing settlement method that you need to disclose for the category of transaction. And again, in the new form, there is a requirement of voluntary transfer pricing entrustment disclosures. That means where you make an entrustment of your profit or price, you can do that in the Form 01, and by doing that, you're exempted from the penalties and interest in case of tax entrustment. There are also clear basis for tax authority to make transfer pricing assessment. It has been a rather common practice where the tax authority rely on forms over substance to determine that taxpayer failed to apply the transfer pricing regulation or comply with the regulation, and they come in and impose a transfer pricing assessment disregarding the taxpayer documentation. That is no longer the case, except where the taxpayer failed to disclose in Form 01, they failed to provide information, the transfer pricing documentation in a master file, local file, or to provide wrong information to the tax authority or dishonest information. There is also a new requirement in the decree which provide transfer pricing entrustment at the year end. But that is, we need to note that the current regulation welcome upward entrustment of your profit for tax, but it does not recognize a downward entrustment of profit for tax. So it would be a challenge for those who are applying global transfer pricing policy, where in certain year you do need to make an outbound payment by entrusting your profit downward in accordance with the policy. So if it is not the case, you need to discuss with your tax advisor to address the tax and custom implication of the entrustment before you do that at the year end. There are also new principles and rules introduced in Decree 20. For the first time, we've got the principle of substance over form, the compatibility of related party transaction against independent transactions. This is actually the arm's length requirement, but it is clarified to avoid the misunderstanding that has been pretty common in practice, where they apply the market price, but actually there is no market price. It is now clarified that it is compatible between the independent transaction with the related party transaction. And we got the new concept of what we call the DMP functions regarding intangibles. So it is about the development, enhancement, maintenance, protections, and exploitation of tangibles. So these need to be analyzed as part of the master file, disclosed in the country-by-country report, and also explained by perhaps the taxpayer in Vietnam in terms of the DMP function or any part of DMP function that they need to perform. The underlying principle of Action 8, 9, 10 in the BEPS package is around allocating profit based on where the value created and economic activity undertaken. and it's very much focused on intangibles. So if your company is involved in things like the product development, R&D, or any potential creations or enhancement of any intangible marketing intangible asset or manufacturing intangible asset, you need to be aware of this new requirement. There is also clarification of the related party relationship, and basically the threshold for relationship is increased to 20% from 20%, consistent with the accounting standard. Also, they remove the requirement of relationship based on the sheer volume of transactions. So for those having more than 50% of your business with a particular parties, you are no longer a related parties unless you have relationship in terms of capital or management. The transfer pricing methodology are almost the same as the transfer pricing, the OECD guidance and the current regulation. It's just a reclassification of the methodology under decree 20. There are also clarity over the healthcare comparables. So basically, for the first time, the regulation in Vietnam recognize use of foreign comparables unless you can't find enough local comparables. And also, the decree clarified the use of secret comparable versus the commercial database. And basically, it limits the tax of the ability to use secret comparable to certain case, basically tax risk assessment or adjustment in case of documentation. Otherwise, you can use your commercial database, which is normally provided by your transfer pricing consultant, and that is an acceptable basis to defend your transfer pricing position in the audit. There are two new rules around the tax deduction for service charge and interest costs. So for the first time, they clarify what type of expense to related party would be deductible for tax purpose regarding the service charge and also interest. They for the first time they provide a cap of interest deduction to 20% of EBITDA, earning before interest, depreciation, and amortization. So in the drafting process, the tax authority consider the OECD guidance, which provide a range of 10 to 30%. They conducted a survey of Vietnamese company in terms of their leverage ratios and the proportion of their interest costs versus earnings. And the government decree concluded at 20% of EBITDA for interest cost deductions. I'm aware that it can be a challenge for certain type of projects, especially in infrastructures, real estate, or certain periods of your business where you are highly leveraged. So if this is an issue, it is important that you address this upfront with the tax authority and also as part of your business planning process. So I'm moving to my last section of the presentation on key consideration for companies. So this page gives you an overview of your self-assessment of transfer pricing risks. So basically, for those companies who are making loss or making profit below the range, they are seen and not having documentation. They are seen as a high risk, and chances they are selected for a transfer pricing audit, as it has happened in practice over the recent years. So in terms of the transfer pricing audit program for the current year, the tax authority are looking at enterprise which are making consistent persistent loss. Normally, those who are making loss for 2 or more years, or those who have not been audited for a long period of time, having tax incentive, having several tax issues pending with the tax authority, or having significant related party transactions. So they can be selected by provincial tax authority or by the General Department of Taxation for a transfer pricing audit. And what we are seeing now, which is what we're going on as, to make sure that the taxpayer have documentation before the audit, or actually they should have it before the tax filing, and explain the position in the audit, and also explain the documentation that is produced for the tax authority. So this comes to my last slide in terms of what companies should do. Obviously, running a risk assessment and readiness analysis for the new rules should be useful and should be necessary in terms of how you're ready to apply the master file, the local file, and country by country report requirement. Having having full documentation for the 16th fiscal year is important. Having APA can be a useful alternative to documentation, and that reduce the burden for you in terms of the master file, local file, C by C. It is important for company to have a look at the corporate structures and transactions and the intercompany agreement to ensure that they got the substance consistent with the form and all of the risks identified in the BEPS guidance are considered as part of the corporate structures and the supply chains in accordance with the Vietnamese regulation. So that comes to the end of my presentation, and I hand over to Van before we start the Q&A.
Very much, Zoom, for your very comprehensive presentation. I know the sound sometimes is a little bit on and off, so I just want to remind all the participants that after the webinar, we will be happy to send the slide deck, as well as a YouTube recording that we've made. So, with the more modern world, we have to depend on the stability of the internet, but we will have that recording for you. So now I am pleased to introduce our partner Nguyen Huy, who is the head of our transfer pricing services at KPMG Vietnam, and he will help answer these questions for us. So we have some questions that were submitted beforehand. Sorry, we have some questions that were submitted before the presentation. And then we have some questions that were submitted during the presentation. So the first question that we have is from Bosch Vietnam. And the question is, when are the circulars guiding for Decree 20 on transfer pricing documentation expected to be released?
Hi, good morning. This is Dan. I think this question was submitted prior to the webinar. So the circular was issued just last week. So circular 41 has already been issued. But they backdated the date of the circular is 28th of April, because that circular is supposed to come into effect on the 1st of May, consistently with the Decree 20. But it has already been issued.
There's a second question from Mr. Se-Hoon from ER. The question is, for a Vietnamese company with an overseas parent company, is there any specific threshold set by the tax authorities to submit that CBCR?
Hi, Se-Hoon. There's no threshold for such. The threshold of 180 billion is only applicable to where the ultimate parent company is in Vietnam. So the requirement regarding C by C is that if the ultimate parent company is not required to submit the C by C in their jurisdiction, then it's not required for Vietnam. To answer your question, the threshold is the threshold of the country in which the ultimate parent company is located. So if it's not required in the ultimate parent company jurisdiction, then you, from a Vietnam perspective, you only need to write an explanation letter to the tax authority explaining that it's not required, and therefore you do not need to submit or prepare any C by C.
We have a number of questions from our friend Min at GS&C. The next question is, for the cap of loan expenses, how to apply for enterprises with loss?
Both the decree and the circular do not provide details on case of losses, but in our view and based on our discussion with the GDT and the MOF, our understanding is that it will not be applicable to case of losses, because there will be no basis for you to determine the 20% EBITDA. So if you're in a loss position, 20% threshold is not applicable.
The next question that he has is the loan interest expenses cap only applied for related party loans?
No, again, it's not clear on that, but the intention is that the 20% cap is applicable to the total interest expense, not just the related party loan.
And then is there any offset with interest income from these loans?
No, the circular and the interest expense. Although OECD, they have recommended at the net, so it's an offsetting. But for Vietnam, we only look at the interest expense.
And then our next question is, does KPMG have an English version of Decree 20?
I believe we have a English translation of Decree 20.
And how much will that cost?
So we can share that with you as well. So do send us an email if you would like to see an English copy of the Decree 20.
So do we have any other questions coming through on transfer pricing in Vietnam? Again, as I mentioned before, we will share this slide deck with you, and then we'll also share the contact information for our transfer pricing team. As you know, KPMG Vietnam has a lot of expertise in this area, and we are always happy to help out people with their market entry expansion plans, with businesses who are already in Vietnam dealing with their transfer pricing sort of obligations, reporting obligations.
Since we still have some time, I think I just want to again emphasize on the key changes, the key requirements applicable from financial year 2017, Decree 20 and the new Circular 41 for your awareness and your preparation. So as explained by Yoon before, compared to the old requirement, which is Circular 66, under which you had to prepare the TP documentation and the disclosure form. The disclosure form in the past had to submit together with the corporate income tax return. But starting from financial year 17, at the time when you submit the corporate income return, you would have to submit the Form 01, which is the disclosure of related party transaction, as well as a checklist related to your master file, that's Form 03, and the checklist for your local file, that is Form 02. And therefore, for financial year 17 onwards, you must prepare your master file and your local file before the deadline for the submission of the corporate income tax return. So if you have a financial year end June or September, you must prepare the master file and the local file within this year, right? So our advice is that for you to check with your head office to see if they already have prepared a master file, right? And see whether that meets the requirement of Vietnam, and you have to start preparing the local file, which should be consistent with what is documented in the master file. So that is more urgent than the 16 report, in my view, right? Because for the 16 report, you still have 30 days to submit the TV documentation upon formal request. But the 17 report, the 17 master file, the checklist of which have to be submitted together with the corporate income tax return for 17.
So we have a couple more questions that Nyang will help us answer. Again, Nyang is the partner for transfer pricing at KPMG Vietnam. Based on the question about Decree 20, the English version, how do we get this file? So Mr. Lee San Ham, we can come back to you after the webinar. We will contact you and connect with you about that. The question from Lin Loon is, our corporation is a joint venture 50-50 of Japan and Australia. Do we need 2 master files and 2 by country reports of 2 groups? Young, what do you think you can answer that?
Yes, the circular clearly clarified that in that case, you would need 2 master files from the 2 countries. Again, regarding the C by C, that depends on whether that is required in the jurisdiction of where the parent companies are, right? So, for example, if in Japan, they were required to submit the C by C, then you need a copy of that. If in Australia, they do not meet the threshold of Australia, they don't have to submit in Australia, then you explain to the local tax authority that it's not required in Australia.
And do we have any other questions coming in? And Lynn, we can always come back to you after the webinar if you have any additional questions about your particular situation. Another question from Min. About the CBC report, do we have to submit a copy of the CBC report prepared by the parent company together with the CBC in Form 4?
The Form 4 is mostly for the local company, local Vietnamese company, which exceed the 180 billion cap, right? For the C by C report prepared and submitted by the parent company, at this stage, you're supposed to have a copy and keep that on file, right? So as you explained before, Vietnam have not signed up to share that information. So once they sign up with other countries to share that information, then they can just get it from the other country. But Vietnam at this have not signed, and therefore they require taxpayer to keep a copy of on file, right? They don't require you to submit that yet.
So for all of you who have joined us and have been sending us questions, thanks so much. We will also get back to you after this webinar with the answers that Young has given you as well, just in case you have other things you need to discuss. Are there any other questions from participants today? If not, oh yes, we do have another one. Sorry, it just takes a while to type it in, huh? This question is gray. Parent company off-sheet balance sheet linked to local company that is subject to 20% limit on tax deductibility against the EBITDA. How long do the arms need to be before this? Sorry, I'm not technical. I don't understand the question. Young, maybe you can clarify.
Hi, Ben. If the company in Vietnam, which is the borrower, have related party transaction, so they're subject to the regulation of Decree 20, okay? And therefore, the 20% interest expense cap, 20% on EBITDA is applicable. And that's applied from financial year 17 onwards, right? So it's a bit strange. Vietnam used to have a thin cap rule, and this is something along the line of the rule, okay? So, but however, it's strange because if, for example, if you do not have related party transaction, and therefore you're not caught by the rules, and what if your total interest expense exceeds the 20% of EBITDA, then it's not applicable. But from our discussion with the tax authority, most likely they will soon revise the corporate income tax return to apply this 20% cap on EBITDA consistently to all companies, not just related party, not with taxpayer, with related party transaction.
Sorry, we have another question coming up. I'm not sure if it's too detailed or not. Hold on one second. Ooh. Sorry. Sorry, this is another question from Ben. How deep do you realistically feel that the transfer pricing regulations will affect the market? Are we a market where light bulbs have been costed at $100 per unit when priced for transfer?
What's the question again? Can I see?
Yeah. I think really the question is how realistic do you feel about the market and the Sorry, we're just trying to figure out the question. And we will be with you in 2 seconds. Ben, maybe you can reword your question. It was about how realistic you feel about the market. We're not sure we understand. Maybe you can retype. And does anyone else have any questions before we finish up today? Stephen Chu has a question. For a subsidiary company of a foreign group in Vietnam, please summarize the requirements to submit the master file, local file, and CBC file. So some of this has been covered in the slides for sure, which we will send to you soon. And also, I'm sure Nhan would be happy to work with you on some of those issues. But Nhan, I don't know if you can.
All right, I'll just quickly summarize again the requirement. So I assume your question relating to the new CP regulation, which is applicable from financial year 17 onwards, right? So there's 4 requirements. The first one is Form 01, a disclosure of your transaction, right? That should be submitted together with the corporate income tax return. All right. Second requirement is a local file. The local file, there's a Form 2, is a checklist for the local file. That should be submitted together with the corporate income tax return, right? And the third one is Form 03, which related to your master file, okay? That should be submitted together with the other 2. The country-by-country report, if applicable, you should have it at the time as well, okay? So those are the 4 requirements. So you should have the master file, the local file prepared before the deadline of the corporate income tax return. And you prepare the Form 01, 2, 3, and 4 if applicable for submission together with the corporate income tax return.
So we can come back to you for more details later, Stephen. Our next question is from Ben. In the transfer pricing report, we use method 4, but in the tax finalization, we've declared Form 3 as a method 3. Is there any conflict with these documents, and is it accepted by the tax authorities or not? We're discussing the answer before we give it to you. Hold on one second.
Okay, I mean, under the old Circular 66, right? So, for example, method 3 is the setting method. That's how you set your price. Method 4 is the method that you use in the documentation to test your price. Okay, so in the past it was not clear. So you can, under disclosure form, you can disclose either method 3 or 4, and that can be explained. But I think under the new regulation, it's clear now that they review to disclose your setting method on the form. So which is method 3.
Our next question is from from Lynn again. When preparing the TPD for all subsidiaries in the group local file, do we have to use the same approach among the LFs?
That depends on whether the subs perform similar function and risk, or so I can't really answer that question. So I mean, it depends on from sub to sub, right? You got to consider the function performed, the risk assumed, and the transaction that they have. Some of the sub have transaction with unrelated party, whereby there's a cup that you can compare, and other sub may not have, and therefore it may not need to be the same approach. But it's got to be consistent with what is documented in the master file.
So our next question is from Min again. But again, some of these questions, of course, we can help deal with after the webinar as well. So if it's very specific, I would say that Young and his team can come back to you. Does anyone have any questions that are more about the overview of transfer pricing regulations in Vietnam, or general questions about some of these issues? If not, we can go ahead and head towards the conclusion of this webinar. So I think it's really clear that transfer pricing is a complex area for investors in Vietnam and people doing business in Vietnam. So we can't possibly cover all the aspects of the issue in just 50 minutes. On behalf of Zung and Young, our two speakers today, let me remind you that KPMG Vietnam has a track record of navigating these interesting areas of business. Please contact us if you would like advice on market entry or expansion on your business in Vietnam. On the screen now, we also have a survey. So we would appreciate hearing what you thought of the webinar today. Please help us by responding to the survey before exiting the event. Only take you probably 5 minutes. And then tomorrow morning, I will send out the slide deck as well as a link to the recording. So if you had any problems listening today, there will be a link to the YouTube recording. On behalf of our speakers, Zung and Young, as well as the team at KPMG Vietnam, thank you for joining us and have a great rest of your day.